The real issue is that we're at the point now where the paper bubble of the stock market is going to inflict so much pain and also data points that the central bank will have to reverse policy once again. And historically, every time they do that, you go back and look at 2000 top, or go back and look at 2007. When the Fed started cutting rates, the stock market continued, in fact, picked up speed on the downside. So Fed change in policy or softening is not going to help the stock market. It's indicative of the bubble breaking. And when they liquefy again, the prime beneficiary are the monetary metals.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for October 23rd through October 30th, 2023, while supplies last. This week we feature three different specials. 1 10th-ounce Gold Philharmonics at $30 over melt with a minimum order of 5. Half-ounce silver polar bears at $2.75 over melt with a minimum order of 100. And 1-ounce platinum maples at $80 over spot. The Austrian Philharmonic is the most popular bullion coin in Europe, and the gold 1 10th-ounce Philharmonic offers additional flexibility along with investor trust. With your order of 5 or more, you pay only $30 over melt. Next, the Royal Canadian Mint is one of the most trusted mints in the world, and the half-ounce polar bear is one of their most popular Call of the Wild coins. 1/2 ounce of 4/9 fine silver, it's available at just $2.75 over melt per coin with a minimum order of 100. Also from the Royal Canadian Mint, we have the 1-ounce platinum maple at just $80 over spot. Many consider platinum to be a highly undervalued metal at the moment, since over the last 30 years, platinum has generally been significantly more expensive than gold, but currently sits at less than half the spot price. Best of all, the 1-ounce platinum maple is just $80 over spot, giving you access to a premier coin in a premier metal at one of the lowest prices in 20 years. All of our specials this week are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Hi, Elijah. Good to see you.
Well, it's great to have you today. I did want to discuss, since the last time we had you on, we've seen quite a run in the metals. What is momentum showing for gold and silver right now?
Well, the plunge we had late last month and early this month, got gold down to around 1820s. And there have been repeated sell-offs since the highs in March, April of this year, repeated efforts to break it back down. The market needed to cool off, after all. It had gone from 1613 back to over 2,000 in a handful of months. So it needed what we called an intermediate correction. It did. It had one. We think the end of that correction was last month. And when we turned up out of the low 1800s, we put out a buy signal at 1862. It was our first significant buy signal. We said, at that point, assume the downside is over. So if you believed in the downside, like it was going to continue, you're wrong. Okay. Well, when it cleared that 1862, within a handful of days, we're pushing the upper 1900s, and now today we're trading credibly over 2,000. Okay. Same time, silver went from a low to a high of a $3 move in 10 trading days. It's since, over the last week, consolidated after those sharp gains. We think there's a lot more to come. Gold is not going to stop this time at the $2,000 barrier that it's hit. It poked up to 2,050 plus in 2020, and 2022 got up to 2,050, 2,070, fell back, and again early this year. We think those are coming out. Okay, momentum has already spoken. It says you're going through. Price guys are no doubt looking at the price chart, saying, "Well, when do I believe it?" Well, they'll believe it when it hits 2,100. Okay, they'll be late, but they'll believe it. Okay. We still think, though, so far, gold is in the leadership mode here. For example, this week, after a huge gains last week and the week before, silver had a pullback of about, right now it's trading down about 40 cents on the week, 30 cents on the week, whereas gold's up on the week about $10, $12. So gold has continued to be firmer than silver. But I think that's about to reverse. where silver is going to suddenly ignite in a way that will impress. Right now, silver's above 23, and I'll throw out a number for you. We get very specific with our subscribers, but basically above 23.40 on a close. Next week, watch that. I'm talking December silver. We think silver will go up another $2 so quickly it'll turn your head. Now, getting up into the 25s, if you'll, even the price guys at that point will suddenly recognize, something's going on here. Because there have been 3 monthly closes over the last 10, 12 months that have each peaked around 25. Traded above it, but that's about the peak close, peak close, peak close. We have some annual momentum structural reasons to assume that if you get back over 25 again, you're going to blow a cork big time. And I will project that if you get up there, if this breakout in the 2340s that I just defined gets you up into the 25s, don't unfasten your seatbelt, okay? Because you're likely to blow out $30 very rapidly. And we think silver over the next 6 to 9 months is going to so vastly outperform gold that it will be head spinning. Okay. At the same time that's going on, there's some other major markets doing things that are helping to cause this event in the monetary metals.
What's happening in those other major markets right now?
Okay, the stock market is a prime focus, even though it hasn't been in most people's minds, because since last year's debacle, and we had a 22% down year for the S&P, a 30-something% for NASDAQ 100, and T-bonds were down like in the 30%. So the major portfolios that people own were decimated. And most people don't even have a portfolio that's going to match the S&P, so they were probably down 30% in their retirement accounts, okay? You've had a recovery this year that made people all hopeful that it's a soft landing and the stock market's going back up. We argue, don't be shocked if this is yet another down year, possibly of significance, such that last year's 20 to 30% drop in most people's portfolios could be replicated pretty severely this year. Now, that's going to put a lot of people in pain because, as we know, they're being pinched on the consumer side. And if their retirement account has suddenly been decimated by 20, 30%, and then again, a decent percent this year, which we kind of expect, that's going to put a lot of pain on the economy, and a lot of the data points that people have been fixated on will suddenly reverse. Now, the Fed is in panic mode that they've not expressed it. Their T-bond market has crashed. Back in August, we put out reports arguing that there would be a nuke type event in the T-bond market where it would go down and blow out last year's price lows in T-bonds, meaning produce higher yields. That happened. And so far, that is the major market for the Treasury Department and for the Fed. If that market goes into chaos, disarray, they have to panic, whether they want to admit it or not. So while they do their press conferences and keep their composure, they've got problems, and they know it. So any issue of further rate rises, you can chunk out the window. Okay. I don't care what the GDP was that just came out the other day. That's illusory. You're going to get data points that will totally negate that going forward, but they'll be lagged to reality. The problem now is that debt market, their debt market. So we know they're in panic mode, though they haven't expressed it. So you can erase the notion of higher rates. And I think it's likely that T-bonds will have a nice sharp rally soon. They were in the T-bond market in price now, we're talking, not yield. The yield going up, price going down. Their price was going down almost in sync with what gold was doing this year. Starting from March, April peaks, they zigzagged down, and you could almost overlay the chart. Certainly the momentum charts look like brother and sister. They were really tied. But then suddenly 3 weeks ago, gold blew out through its structures to the upside, and T-bonds didn't. I still think there's a chance that T-bonds could have a V-type bottom here, meaning rates start to drop. And that's not because the Fed is going to drop short-term rates. It's because, one, the market is vastly oversold, the government debt market. Two, a lot of large asset managers have been big shorts, okay? Bill Ackman just recently announced that, he'd made a ton of money since August being short the bond market. He covered, and he implied that it could be bullish here. I think you're going to see more of that. And it's two things that cause that, I think. One is the old portfolio notion of 60% stocks, 40% bonds. Well, it didn't work last year. It was a disaster on both scales. But I think bonds are about to rally and provide an alternative to stocks. Now, stocks are starting to weaken and break down to where people are starting to notice it. Now, we got negative at 44, 4,500. It's now in the 4,100s, and I suspect you're going to go under 4,000 pretty quickly. That's S&P 500. Portfolio managers are going to have to reallocate assets to something else, whether they like it or not. And I suspect some of that money will go into bonds and therefore help create a V-bottom situation, meaning combining Federal Reserve trading desk buying of T-bonds, which they're no doubt doing to support their market, coupled with large asset managers shifting money over while they dump stocks. But notice what's been going on all this time. What core asset has been behaving well? None except gold. I mean, it's been lingering around the 2000 level repeatedly, even despite the notion that the Fed's going to raise rates forever, et cetera, et cetera. Or if the stock market goes down, gold has to go down. Nonsense. Gold knows better. I think it knows that the central bank is in panic mode. And there's only one outcome of that, and that is they're going back to monetary excess and panic. And gold will be the prime beneficiary.
We're seeing maybe an abandonment of the major asset classes, as you mentioned, stocks and bonds. They're both falling at the same time. Can you kind of expand on this major shift that's going on? And it seems like, as you mentioned, the only asset that's rising is gold. When do you think the public is going to start recognizing this?
Well, they'll start recognizing it when you blow through the old highs in gold. We know that, 2070 area. If you want to round it off to a $50 increment point and figure chart, you've had 3 hits at 2050. Okay. We're above 2000 again. Okay. You go back to those old highs and blow them out, touch 2100, for example. That's what we call an idiot chart, meaning everybody can see the price chart. At that point, people are going to have to say, well, good grief, I guess I was wrong. I doubted gold. I got out of my position, et cetera, et cetera. At that point, I think you'll have an increased flow because even the dumb asset manager, and there are a lot of smart ones, but even the dumb ones will say, golly gee, this is working. I need to move some money over there. Now, I think one of the beneficiaries, once that occurs, will be the miners. Because, if you believe in the notion of buying something that's dirt cheap and probably can't go any lower, then if you look at the miners right now, gold and silver miners, I'm talking about, not base metal, and compare them to the S&P 500 going back decades, with percent of the price is GDX versus the S&P, it's off the page cheap. Okay. And it's behaving fairly well. I mean, after all, since the low early this month, GDX went from the mid $25 level up to over 30. Right now it's trading, I think, above 29. So it had a good percent recovery also over the last several weeks. From 25.5 up to 30 is a big percent jump. I think it could reignite in a big way and also blow out its price highs, which over the recent years have been around $50. I think that could happen very quickly. And I think the reason that would happen again is the recognition by large portfolio managers who need an alternative place to be. And they look around and say, what's doing well? And whether they like it or not, the gold miners are behaving well. Gold is behaving very well. And especially if you get some more rejuvenation out of silver and the miners in the next few weeks, the recognition will be, hey, this is a place to be. The problem is, or the good news is for the gold investor, those are very small sectors. So when these big hands start to move into that small sector, it's going to be grabbing like a wet bar of soap situation. And I think that's when you could get a sudden tonal change in those monetary subsectors, silver and the gold miners, to where they outpace gold. So I think the time of the congestive process of the last few years, I think it's over. I think it's time to think that, okay, cork's coming off. We're going for the big move now. And I think it'll be substantial.
Now, what are the fundamental drivers here? Because I know this last move in this month has been a big fundamental driver would be the increasing conflicts in the Middle East, along with, obviously, so it's the second war that's starting now. but it's not like the Fed has done anything to ease or anything like that. Your perspective on the fundamental drivers, yeah.
Unless they've done it in the dark, in the nighttime trading desk buying T-bond futures. Because I suspect, looking at the market at night, they trade these things late at night, okay, that the T-bond market's been supported by the Fed lately. And I think when large asset managers start to pour in, you could get a V-bottom situation there where rates start to drop on the long end, especially. And that's largely an asset reallocation by asset managers who are making the decision, this sector's too cheap, I want out of that one, or less in my stock position. I don't think the bond rally will last long. I think it may be an event that very sharp, but only last a quarter or two. But it could be very sharp. And I think what it's indicative of is the Fed panicking. They have to support the government debt market. That's what they're there for, okay? And if the government can't be funded by taxes, and it's not being, and this year won't be good either, I don't think, from the tax revenue point of view, they need to be supported somewhere, and it's by printing money and buying government bonds, the Fed. I think gold knows this, and I think what's driving gold is not a war event, although it's a peripheral help. Remember, we had the Russia invasion of Ukraine in February of 2022. And if you bought gold then, you got hammered, okay? So he had a major war event, arguably larger than this one in terms of, dimension and implication, and yet gold went down. It was not at that point that gold needed to correct, and it did. And the Fed was going on a tightening process starting in March of 2022. So shortly after that invasion occurred, the Fed started the rate hikes. And so gold went down and congested, okay? And it actually sold off pretty good in the 1600s. So war didn't help gold then. I think the war now is only marginal in the sense that it increases the government's need for funding, okay? Particularly because we're more involved in this to some extent. We may get a lot more involved. But overall, the real reason is that they know the central bank has to liquefy the system again because its bubble is breaking, regardless of the Israel-Hamas situation or Iran situation. That's just peripheral additional mix to the thing. I think the real issue is that we're at the point now where the paper bubble of the stock market is going to inflict so much pain and also data points that the central bank will have to reverse policy once again. And historically, every time they do that, you go back and look at 2000 top, or go back and look at 2007. When the Fed started cutting rates, the stock market continued, in fact, picked up speed on the downside. So Fed change in policy or softening is not going to help the stock market. It's indicative of the bubble breaking. And when they liquefy again, the prime beneficiary are the monetary metals.
And again, looking at the banking system, I know we've covered this extensively with you. Your perspective on how the banking system will be impacted here. Jamie Dimon actually just sold some of his own company's stock for the very first time. So your perspective.
First time in years, yeah. He's been on top of the situation pretty well. A year or so ago, he was warning that this Fed policy thing is going to cause consequences. Don't bet on a soft landing. And he's going to be right. No, the banking sector we know crashed back in March. It was literally a crash event because the dimension of the drop and the speed of the drop qualified it as a crash. They blamed it on regional banks, a couple badly managed regional banks, not Fed policy or anything like that, or the fragility of the system. But if you looked at the major bank stocks, the top 10, like Bank of America and Citicorp, for example, two of the top 10, and looked at their price charts, well, the S&P has been laboring nicely off of its 2022 lows. They were back basically on the mat, on the lows. No, they hadn't broken below them substantially, but they were on the mat, whereas the S&P was in this nice buoyant rally. We've been stressing since January, before the bank crash, in fact. Watch out for the banks. There's an ambush situation here. The ambush came in March, and now we think it's broader. Now it's the broad leading banks. Even if you just look at their price charts, you could see ugliness. That has to have the Fed even more panicked. They don't care about NVIDIA, but they do care about Citicorp, Bank of America, Goldman Sachs, Morgan Stanley. Those charts look like heck. And I'm sure the Fed is aware of it, and I'm sure they're getting phone calls from the CEOs of those banks. Much conversation going on behind the scenes. This helps create the change in central bank policy toward what gold knows is coming. A massive liquefaction of the system, probably more than we've ever seen, simply because of the nature of the large bubble that is breaking. Biggest stock market bubble in U.S. history. And the Fed will have to come in, all emergency measures, and I don't know how they're going to make the transition intellectually and in press conferences. They're going to have to do it. And I think the bond market knows that. That's why I expect a V bottom there. Another area to watch is the broad financial sector. XLF is the ETF that covers that. That includes not just some banks, but insurance companies, American Express, credit card companies, and some large asset managers like BlackRock's in there, so forth. That looks extremely vulnerable right now to a major drop. It's challenging its 2022 lows now. The S&P is not. S&P was at 3,500 last year. We're still above 4,000. But XLF is back down to its 2022 lows, while the banks are well below. But the broad financial sector now looks like it's going to join the banks, which means it's not just banks anymore. There's also some other sectors out there that will ambush people psychologically. One of them in particular is one that's been so comfy for the last 2 years that asset managers must be asleep at the wheel. Healthcare sector. It has broken some stuff this week, this month, that indicate to it's going into a major bear market. And that would surprise people. And what creates downside more than anything? A surprise. Anyway, I think the stock market is now starting its second major leg. I don't expect a crash situation. No need for that. Most big bear markets don't entail crashes. And I think gold will shrug it off because gold knows gold is focused on the Fed.
And you mentioned how people probably, and obviously we don't offer trading advice or financial advice, but you mentioned how a lot of people might think, at $25 silver or maybe $2,500 gold, that would be the time to kind of unload positions. And I was just interviewing David Morgan, and he said a similar thing, how a lot of people who have been tracking the precious metal markets for years will actually miss the big move. So your perspective on that?
We've done a lot of research on it. And I state that I think that silver and gold miners will suddenly, like a snapped rubber band, catch up and outpace gold. That usually occurs late in a bull trend. If you go back and look at the 1970s, late 70s to 1980 bull market in gold and silver, and look at the move from 2000 to 2011 in gold, most of the move occurred in the final several quarters of the bull market. This is true with both the price of gold, price of silver, and the miners. Whereas the miners in silver might have lagged gold or been sort of sloppy in their uptrend while gold was firm. But in the last, even less than the last year, like the last couple to 3 quarters, that's when silver went ballistic in terms of percent gain. Like go from $20 to 50 in a heartbeat, whereas it took it years to get up to 20. And you go back and look at the charts then. Again, late 70s, like 1979 to 1980, silver went off the page compared to gold. And it did the same thing in 2011. But it was very lagged to gold. Well, you've got to realize that this bull market in gold is already 8 years old. It's not a young bull market. And it wouldn't surprise me if we're now entering, due to the tectonic events that are underway, they will not move incrementally. These are big, noisy events. That gold will have its explosive part of its bull trend in 2024, and that it could be meteoric, both for the price of gold, but especially the price of silver and the miners. I don't expect silver to stop at $50 in this next phase. I don't expect it to stop there. It's stopped there twice in history. I think it could go way beyond that. Now, again, context. Go back and look at the bull markets in gold, like from 1970 through 1980. It was a zigzag in 76, admittedly, a 50% correction. But gold went from $30 to $850 over a 10-year period. Okay, that's a huge percent. Okay. Then take 2000 to 2011, 11-year bull trend. Gold went from $250 to $1,920. A lot of that occurring in the latter quarters. We started at $1,054 in December of 2015. We've only doubled. So this bull market is aged, but again, most of the gain occurs late. That's a historic fact. But if gold were to match, let's say just match the multiples of the bull market from 2000 to 2011, we'd go to $8,000 gold, eightfold move. The events are far bigger than that are going on outside of gold. And I think the consequences could drive it even further. Well, any case, what I'm saying is that there's a lot more to go in gold. Don't take profits on the next surge. Maybe 9 months from now, if we're at $8,000 gold, consider it. We'll update that to our subscribers. Of course, we analyze along the way. But I expect this next phase of the gold-silver market move to be quite stellar. And one thing they've got different this time around, if you look at the other markets, there's times in the past when gold has gone up that there have been other alternatives. Like during a lot of that gold move from 2000 to 2011, stock market bottomed in 2002, remember, while gold was starting up. But even the stock market was advancing during a lot of those years. So gold had some competition. Right now, you look across the horizon and you can't find competition, which makes the situation even better for the gold market.
Well, it'll be very interesting to continue to track this with you, Michael, as we've been doing. And it seems like times are just getting more interesting by the day in the markets here. Where can people find you online if they're interested in really learning a unique approach to the markets, which is momentum?
OliverMSA.com stands for Momentum Structural Analysis. You'll find a section there where you can click on I've got a picture of myself and my son, so the co-analyst, and I've got my email address there. Click on it and request some sample copies. Be happy to forward them gratis.
Fantastic. Michael, thank you so much for your time today, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.